self-storage versus multifamily. There's a major misconception or even a lie that goes around about the safety and failure rates of these two assets that I'm going to break down and show you. It has always been one of my biggest pet peeves. Now, while we walk through this, you're going to see how bad multifamily is getting, and it's gonna get worse. Then the question becomes, what about storage? And how do these two compare? An actual risk. And therein lies the great lie and misconception. One that you have seen on articles, on the TV, and put everywhere. Self-storage is the lowest defaulting commercial real estate class out there. But is that actually true? And the numbers and why will surprise you. But first, let's look at the pain and the problems that are going on in the commercial real estate space with multifamily apartments. In the last 12 months, multifamily delinquency rate has nearly doubled. The CMBS, which is the loans that are in multifamily that are distressed, has exploded. Delinquency plus special servicing has gone up 5 times in the last 12 months. We've been hearing about this for a while, but as the numbers show, it looks like it's just getting started, and it very well could be just the start. Why? Because of the maturity dates. You see these loans coming due that they're no longer able to service because they were locked in at such low rates are now tripling. All at the same time when you have markets that are very much oversupplied, meaning occupancy and rents are dropping, and the amount of loans that need to be refinanced and coming due is jumping in the next 2 years. Now, this leads us to the numbers that everybody shows. Self-storage default rate in even 2025 was about 0.11%. That's 0.11, not 11. While multifamily was 6.5 at the time, and that has increased dramatically. Now, this seems like worlds apart, but the problem is it's wrong. You see, when people see this, they think, oh, self-storage is not just safe, it's recession-proof. It doesn't default. And multifamily seems way risky in comparison. So let me show you why and how those numbers are not correct. First, I am a self-storage guy, so you would be thinking that I should be saying, no, we're so much better and these numbers are right. But the problem with that is, it is not correct. And I don't care about assumptions, I care about reality, especially when I'm investing. And having been in the industry for over 20 years, understanding how these numbers are compiled, I understand why they're wrong. This has created a big gap in the reality that people are seeing and feeling versus what is being said. In 2025, we purchased over 500,000 net rentable square feet of assets that were being lost. I've worked with lots of individuals that have been going bankrupt and losing it all, firms that have completely shut down. People see in performance how the performance numbers over the last 3-4 years of storage has been bad, but yet there hasn't been defaults. So why is that? Well, the answer is, it's not that the numbers are wrong, it's where they come from and what they mean that are wrong. Put this way, when looking at the default rate of multifamily compared to self-storage, where does that number come from? That number comes from CMBS loans or other debt products that are publicly known, that we can actually get the numbers from. And this is where the problem comes from. Why? Because the majority of multifamily loans are in public markets. In storage, they are not. So if you compare just the public loans, of course, it looks like that. You're comparing the default to the total amount of assets. But the reality of the situation is, in multifamily, you're comparing the default of the majority of the assets, and in storage, you're only comparing the default that is within these loan products. We do not have the information for where the vast majority of all loans in storage is done. So we don't know. So let's take a look at how this debt structure works. The vast majority of self-storage loans are done on a local level. Credit unions, private institutions, and banks. They are not public information. In fact, CMBS loans only represent 12% of the industry. The CMBS loan default or distress rate for self-storage is that 0.15 right now. That's where they get the default rate. But that only represents 12% of the assets. It also only represents the assets that are in the major markets. Those are the safest markets. They also represent only the biggest owners, which only make up a quarter of all asset holders. You can see in red what is reported versus on the side, blue that is not reported, not known, versus the actual reported amount. Now, the reason why you have unreported amounts is CMBS loans are bonds, which are put together with other loans. They are very strict. You just can't work it out with a CMBS lender because the lender is a bondholder. Whereas local credit unions, banks, private SBA loans are direct with the lender, they're on a localized branch, and they work with those people to figure out the loan payments. They restructure, they stop paying the loans, they sell off the asset before it defaults, but none of that is reported. And even if it does default, once again, it's not publicly traded information. Now, let's compare that to multifamily. And here you see the reality. Multifamily, 52% is very known public information. 19% is semi-known. We're still pulling data from it. Only 29% of multifamily is unknown. In storage, 80+% is unknown. Only 12% represents that publicly traded market and information. So what are the real numbers? Well, we actually don't know. Now, it's important to know that yes, self-storage is a lower defaulting asset overall in total probability. And that lends to things like cash flow, as well as opportunities to diversify lower expense loads. But it is nowhere near the reported 0.11 or 0.15%. How close is that to multifamily? We have no idea. But we do know there's massive issues in the self-storage market. Why? Because we can look at the type of asset and what's happening with it. Meaning, in 2019, 2020, 21, and into 2022, even though it had already started to come down, there was an explosion boom of new supply. Everybody saw this and felt it. There was a new storage facility coming up on every corner. This boom led into 2024. After that, it drops off like a cliff. The reason being is self-storage started to struggle. Occupancy, rents, and those assets that are new, that new supply hitting the market, they're not filling up. And they weren't filling up at the rates that they looked at. Because when you develop an asset in 2022 or 21 or 20, when the market was really good, that asset actually doesn't come online until 24 or 5. So the market that that asset actually enters into is totally different than when it was originally started to be built and under construction and financed. As those assets started to struggle, then the pipeline started to shut down in 23 and 24. Therefore, new supply coming out started to tank in 25, 26, and the projected of 27 and 8 is even lower. The transaction volume seized and fell off a cliff because what someone was willing to pay versus what the sellers needed to make it work with debt and the cost that they had was astronomically different. We can see this in the transaction volume. 21 and 22 were insane. We went from 20 billion to, in 2025, 2.8 billion in total transactions for the industry. That's less than half of what was in COVID, when COVID started and everything shut down in 2019 and 20. And this gets us to the risk profile. The deals that have the highest risk are new CO deals. What is a CO deal? That means certificate of occupancy. That just means a deal that was developed, and when it's ready to be opened, it gets its certificate of occupancy to open up to the public. So those are new development deals. The next risk is in fill-up mode. Facilities that have opened and they're trying to fill up. Then you have the stabilized assets that have been stabilized and already had rates, occupancy, and probably had lower debt. But as you remember, the amount of new assets and the price of those assets and the transactions was enormous for multiple years. When interest rates were low, self-storage was booming. That created what I call the self-storage bubble, and we talked about back in 2021 and 2022. It was overdone. That overdone then created pain as markets retreated and came back down to earth. But just because markets retreated, that didn't stop all the assets that were currently underdeveloped from coming out. They'd already started, you just can't stop, which further hurt markets as new supply entered into a market that was already struggling. Why is that important when it comes to defaults or delinquencies? That's because construction loans and the loans on fill-up facilities are not CMBS loans. That is a totally different category, which has the highest default. So when looking at the difference of risk between multifamily and self-storage, it is not nearly as simple and clear as it seems. And the numbers, particularly the number in the default rate of storage, is not even close to being correct. It measures only 12% of our market, and only the biggest operators in the biggest markets with the nicest assets. It also looks at stabilized facilities. So of course, the default of those will be very, very low. It's a totally different picture when you look at the rest of the industry. Whereas multifamily, we get a much better picture. Why? Because that represents a major portion of the industry. Now with that said, yes, self-storage probably defaults at a much lower rate than multifamily. But one of the reasons is the debt load on multifamily is much higher than on self-storage. So interest rates affect it at a rate that is very different between the two asset classes. But you have to be careful with these numbers. These are numbers that no one has ever even challenged. They just accept it. All major brokerage firms, Wall Street, everybody in between produces these numbers that show self-storage is so incredibly risk-free. And that gets people to think they can't lose. That creates bubbles like we saw. The truth of the matter is, no, self-storage is not recession-proof. And yes, there is pain and struggles in the market. Those pains and struggles in the market, although they may be less, are significant. Now, this leads to major opportunities, like the ones that we are currently buying, and we're buying a lot because we can buy at lower than replacement cost. We're getting deals that we haven't seen since 2010 and 11 in this industry. But you have to know where to look, how to assess the risk, and you have to be careful. You also have to remember that the vast majority of self-storage funds, syndicators, operators, and everybody in between came after 2017 and 18. That means they've never been through a real estate crisis before. That exasperated the problems. What does the future hold? Well, the same problems that we are seeing leads to a boom. Why? Because new supply coming onto the market vanishes. And just like supply coming onto the market makes oversupplied markets, when you can't supply the market with new inventory, it creates undersupplied markets. And this is why real estate has big swings. Those that make it through, like we have and we did in 2008, the other side of it is incredible because you have abnormal demand. Occupancies go up, rates go up. And most importantly, you're buying assets at a basis that is not normal. They're astronomically low. Some of these assets we're buying at banknotes, or the banks are even writing it down, which even though the individuals are losing their assets, their money, that's not publicly known and it doesn't go into the numbers that we see. The opportunities right now are incredible, but when evaluating the difference between which investment you're picking, you need to understand the actual numbers. Because if you don't, you're gonna make mistakes. But when you do, you can take advantage. You wanna know more about where the self-storage industry is and where it's going in the next 5 years so you can see and identify opportunities or even just know? Check out this video here. And make sure you guys are liking, subscribing, so you can see what's really happening, not just what is on the news or a headline. And if you want more, check out the weekly podcast on self-storage income, where we dive into real-time changes, opportunities, and what's happening. Let me know in the comments, what are you seeing out there? Because so much of this is localized, it's very different from market to market. So let me and others know, what are you seeing? And let me know your questions so I can help you understand what's actually happening.